Giving us part of your Tuesday morning. Stimulus measures on behalf of Republicans are definitely on the minds of traders. Now, I guess I'm wondering, they've done their job. Now it's time for Democrats to get this package in front of the president for his approval. My guess is most expect we'd see something prior to the summer break. So no major surprise here, but it's good to have at least us headed into that next phase.
Yeah, I think that's right. There was a great degree of concern that the measures that they passed earlier this year were set to expire. I believe it was last weekend. And so it looks like they're going to get something done. I would expect that there's enough bipartisan support for that we should see something on that front relatively soon. So I agree with you.
So, Luke, as we wait for that, that's definitely impacting markets. We certainly saw a gold on the move. I guess one could debate, though, now that we've had the debate in terms of they've presented it, will probably start to debate, is it enough, and will there be more to come? Ultimately, do you think there will? It seems like the Fed has certainly made it very clear to lawmakers that they need to step up their efforts as well.
Yeah, I do think there'll be more to come. I think this is the start of something we're going to be seeing a lot more of for a long time to come. I think something that's been left out of a lot of the discussion around COVID and the economic crisis and recession we've had since has been, we went into this with the U.S. government's finances in the worst shape they've been since the immediate aftermath of World War II. And so we knew going in that whatever the next crisis was, even a small crisis, was going to create some very big and lasting fiscal problems that would require some pretty unique, at least relative to the past 60 or 70 years, measures to combat. And that was just if we had a little crisis. Now, of course, what we've seen with COVID is it has been a very big crisis, interrupting not just financial markets, but actual real global trade, real activity, et cetera. And so the measures we've seen so far have been more aggressive than what we've seen over the last several decades. But because we came into this with the U.S. And it's not just the U.S. to be clear. It's a problem for much of the Western world. Sovereign debt levels are at all-time highs, basically. But speaking particularly of the U.S., we came into the situation with the fiscal position in so precarious that basically this has now pushed us into essentially a fiscal crisis. And so my guess is we're going to continue to see these packages rolled out, and they probably continue to get upsized over time as well.
Yeah, you bring up a good point. Debt was a major concern headed into this crisis. I wonder if this is somewhat what's weighing on the U.S. dollar, if many people are looking at this in kind of the scenario that you just created and seeing the sort of potentially the straw that breaks the camel's back. We certainly have seen the dollar impacted directly by this stimulus measures and uncertainty, whether it be strength in Europe or some of the other contributing factors. Even the yen starting to rally right now. But maybe what you just brought up is a good focal point, the fact that we're really kind of backed into the corner right now as far as some of the concerns and debt concerns specifically.
I think that's right. And I think, too, within that, and it's gotten a little less airtime in financial media, but I think it's important to highlight as well that back at the end of May, the U.S. government declared it was their word. It wasn't essentially, they declared, in their words, a new great power competition with China.
Right.
And this document was a lot like George Kennan's declaration of what was essentially the Cold War right in the aftermath of World War II, as a number of different market observers have pointed out. And so when we were coming into the COVID situation or crisis with an incipient fiscal crisis, and COVID made it more acute, but then we've layered on top of this a new Cold War, effectively, a great power competition. And these are very expensive. And things are in flux, but I'm pretty sure the Chinese are not going to finance a new Cold War against the Chinese. And so you look around for who can finance that, and it's likely going to have to be some combination of the Fed, the U.S. banking system, regulatory changes, and none of that on net is good for the dollar.
Talk to us a little bit, Luke, about what you're seeing in terms of rates. I've been watching the 30-year, which has been coming off pretty rapidly off that 1.8% level, back down to 1.2, but even the shorter end's been coming off at a fair clip as well. What are you seeing?
Yeah, I think it's been interesting to see. I think there's probably been some concerns regarding the renewal of the stimulus package. I think there's been some concern around the second wave and what that would mean for the economy, what that would mean for the V-shaped recovery, what that would mean for credit risks across the economy. And so I think you've seen some of that play out across the yield curve, and that's probably been the biggest parts of what's driven that in recent weeks.
What are you going to be listening for in terms of Fed tomorrow, the FOMC meeting, comments in the statement, and then also in terms of the question and answer session?
I think it'll be, my view is it'll probably be more of the same, basically trying to assuage markets that they're going to do whatever it takes for a longer period of time and probably try to continue to goad the fiscal authorities to spend more. We saw a really big deficit number in, I think it was June, $800 billion plus. As long as the dollar's holding in relatively okay, I don't know why they don't keep trying to spend that amount of money until you get a response in the dollar, until you get the response in the economy. But I think that really that's what the Fed would probably be on message saying is we're going to stay doing what we're doing, and we need the fiscal authorities to do more to really get this recovery to be more robust.
Expectations for them to mention anything in terms of yield curve controls? There's been a lot of talk, a lot of murmur, kind of rumor about that.
I think they'll probably continue to talk about it as a way of continuing to flag that. I think that's where this movie is going. A number of people have made the point that we're de facto already there to a certain degree, and I think that's probably true to some extent. But I think it's a little bit different. I guess for me, the big moment will be when, and I think it is a when rather than an if, the fiscal authorities say, hey, we're going to spend whatever it is we're going to spend, $800 billion a month in deficits to stimulate the economy, rebuild infrastructure, recover from COVID. And then the Fed says in partnership with that, or at the same time as that, we're not going to let the 30-year or we're not going to let the 10-year go over 1, no matter how much they spend. And I think that's where it really, I don't think we're at that moment yet. I think they that explicit of yield curve control, but I think they will continue to talk about yield curve control just to give market participants, set that narrative for when they want to do something a bit more aggressive than they already are, which I think could be later this year, early next year.